ExamPrep.School, Indiana Life and Health Insurance Exam. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Accident and health policy provisions, clauses, and riders. Accident and health types of policies. Completing applications, underwriting, and delivering life policies. Field underwriting procedures and producer practices. Indiana accident and health insurance regulations. Indiana laws and department rules common to all lines. Indiana life insurance regulations. Life policy provisions, options, and exclusions. Life types of policies. Other accident and health insurance concepts. Retirement and other life insurance concepts. Social insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. In an annual renewable term life policy, how does the premium structure differ from that of a level term policy? A. Premiums increase annually based on the insured's attained age. B. Premiums remain constant throughout the initial term period. C. Premiums are guaranteed level for the entire policy duration. D. Premiums decrease each year as the insured ages. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is that annual renewable term premiums increase each year to reflect the insured's rising age and mortality risk, whereas level term premiums stay fixed for a specified term period only. Reason B is not correct. This describes the structure of a level term policy during its level period, not annual renewable term. Reason C is not correct. No term policy guarantees level premiums for the entire policy duration. Level premiums apply only for the initial term. Reason D is not correct. Term premiums do not decline over time. They typically rise in renewable plans to reflect increased age-based mortality costs. Question 2. A convertible term life insurance policy includes a conversion privilege. Which description correctly defines the timing allowance of this provision? A. It permits conversion at any time before the policy's expiration without evidence of insurability. B. It restricts conversion to the first 5 policy years unless evidence of insurability is provided. C. It allows conversion only at the first policy anniversary. D. It requires conversion prior to age 55 with proof of insurability. The correct answer is A. The conversion privilege allows the policy owner to convert term coverage into a permanent policy at any point before the term policy expires without furnishing evidence of insurability. Reason B is not correct. Policies typically do not limit conversion to only the first 5 years. Conversion periods often extend through the term without proof requirements. Reason C is not correct. There is no restriction confining the privilege to the first anniversary. It applies up until expiration. Reason D is not correct. Age-based proof requirements are not standard. The privilege usually applies without evidence until the policy ends. Question 3. Which feature is characteristic of a non-renewable term life insurance policy at the end of its original term? A. Coverage terminates, requiring a new policy application for further insurance. B. Coverage automatically renews without evidence of insurability. C. Premium rates remain level for subsequent terms. D. The face amount decreases to 0 while premiums stay constant. The correct answer is A. A non-renewable term policy ends at the close of its term and does not automatically continue. Applicants would need to apply for new coverage to maintain protection. Reason B is not correct. Automatic renewal without proof describes a renewable term policy, not a non-renewable one. Reason C is not correct. Level premiums for subsequent terms apply to level term policies and only if renewed. Reason D is not correct. Decreasing face amounts describe a decreasing term policy, not a non-renewable term. Question 4. In a decreasing term life policy designed for mortgage protection, which of the following accurately describes its benefit and premium pattern? A. The death benefit decreases over time while the premium remains level. B. Both the death benefit and premium decrease proportionally over the policy term. C. The premium increases annually based on the outstanding mortgage balance. D. The death benefit remains level while premiums decrease each year. The correct answer is A. Decreasing term policies for mortgage protection pay a death benefit that declines over time in line with the loan balance, while premiums stay flat throughout the policy term. Reason B is not correct. Premiums for these policies do not decrease. Only the death benefit declines. Reason C is not correct. Premiums are fixed and not linked to mortgage balances in decreasing term designs. Reason D is not correct. Death benefits in decreasing term policies do not stay level. They decline to match mortgage reduction. Question 5. A 35-year-old homeowner with an adjustable rate mortgage expects the outstanding balance to rise each year. The client wants a term life policy whose death benefit increases over time to match these growing obligations. Which policy feature best fulfills this requirement? A. Level term. B. Decreasing term. C. Increasing term. D. Return of premium term feature. The correct answer is C. This option is correct because an increasing term feature raises the death benefit periodically to align with increasing financial obligations, whereas the other options either keep coverage constant, reduce it, or refund premiums. Reason A is not correct. A level term maintains a fixed death benefit throughout the policy term and does not adjust for rising obligations. Reason B is not correct. A decreasing term feature reduces the death benefit over time rather than increasing it. Reason D is not correct. The return of premium feature refunds paid premiums at term end, but does not increase the death benefit during the term. Question 6. A 30-year-old non-smoker buys a 20-year term life policy, but worries about paying premiums without receiving any benefit if the policyholder outlives the term. Which optional feature should be added to ensure premiums are returned at the end of the policy term? A. Return of premium term feature. B. Level term. C. Renewable term. D. Convertible term. The correct answer is A. This option is correct because the return of premium feature refunds all paid premiums at term expiration if death has not occurred, while the other options do not provide a premium refund. Reason B is not correct. A level term maintains a constant death benefit but does not refund premiums if the policyholder survives. Reason C is not correct. A renewable term allows policy renewal without evidence of insurability, but does not return premiums. Reason D is not correct. A convertible term permits conversion to permanent insurance but does not refund premiums at term expiry. Question 7. Which of the following is a guaranteed feature of an ordinary whole life insurance policy? A. Adjustable death benefit options at policy anniversaries. B. Scheduled non-forfeiture dividend payments under a participating policy. C. Flexible premium adjustments based on cash value accumulation. D. Guaranteed level premiums throughout the policy's life. The correct answer is D. In an ordinary whole life policy, level premiums are guaranteed for the entire duration. Dividends are not guaranteed. Premium flexibility is a universal life feature, and adjustable death benefits pertain to other contract types. Reason A is not correct. This is wrong because adjustable death benefit options are characteristic of universal life policies, not ordinary whole life. Reason B is not correct. This is wrong because dividends depend on insurer performance and are not guaranteed. Reason C is not correct. This is wrong because ordinary whole life does not allow adjustments to premium amounts. Question 8. Which of the following accurately describes the premium payment and coverage relationship in a limited pay whole life insurance policy? A. Additional premiums must be paid if the cash value falls below the guaranteed amount after the pay period. B. Premium payments stop after the pay period and the death benefit reduces proportionally thereafter. C. The coverage and premium payment periods both terminate at the end of the pay period. D. Premiums are payable for a set period, after which the policy remains in force until age 100 without further payments. The correct answer is D. Limited pay whole life policies require premiums only for a defined period, after which the policy stays fully in force at the guaranteed death benefit until maturity age without any further payments. Reason A is not correct. This is wrong because no extra premiums are required once the specified pay period is completed. Reason B is not correct. This is wrong because the death benefit remains level when premiums cease under a limited pay design. Reason C is not correct. This is wrong because coverage does not end with the premium paying period. It continues unchanged. Question 9. In a single premium whole life policy, which risk is most significant for the insurer at policy issue? A. Expense risk related to ongoing administrative costs exceeding premium reserves. B. Lapse risk due to the policyholder discontinuing premium payments. C. Mortality risk increasing as the insured ages beyond the premium payment period. D. Interest rate risk arising from investing a single large premium to meet future obligations. The correct answer is D. With a lump sum premium, the insurer faces significant interest rate risk in investing those funds to support long-term guarantees. Lapse risk is minimal since no further premiums are due, and mortality and expense risks are typical but less pronounced. Reason A is not correct. This is wrong because expense risk remains standard and is less significant than interest rate risk in this context. Reason B is not correct. This is wrong because lapse risk is negligible when there are no future premium obligations. Reason C is not correct. This is wrong because mortality risk does not peak uniquely at issue for single premium policies. Question 10. Which statement correctly distinguishes cash value from face amount in a whole life insurance policy? A. Face amount denotes the policy's cash accumulation, and cash value indicates the payable death benefit. B. Cash value represents accumulated savings available for surrender value, whereas face amount is the guaranteed death benefit payable to beneficiaries. C. Cash value decreases over time while face amount increases with policy dividends. D. Face amount reflects the policy owner's equity, and cash value remains constant until policy maturity. The correct answer is B. In whole life policies, cash value accumulates as a savings component and corresponds to the surrender value, while face amount denotes the guaranteed death benefit paid to beneficiaries. The other statements either reverse these definitions or misstate their behaviors. Reason A is not correct. This is wrong because it reverses the definitions of cash value and face amount. Reason C is not correct. This is wrong because cash value does not decrease over time, nor does face amount increase automatically with dividends. Reason D is not correct. This is wrong because face amount is not equity, and cash value grows rather than remaining constant. Question 11. A policy owner borrows $10,000 from a participating whole life policy at an annual loan interest rate of 6%, but fails to pay any interest when due. Which of the following describes how unpaid policy loan interest is handled? A. Unpaid interest is waived if the policy remains in force. B. Unpaid interest is automatically deducted from the cash value. C. Unpaid interest increases the policy's death benefit. D. Unpaid interest is added to the outstanding loan balance. The correct answer is D. The correct answer is that unpaid loan interest is capitalized and added to the outstanding loan balance, causing the loan to compound over time because whole life policy loans accrue interest that is not automatically paid from other policy values. Reason A is not correct. Unpaid interest is never waived simply because the policy stays in force. It must be repaid or capitalized. Reason B is not correct. Unpaid interest is not deducted from cash value. The cash value remains intact until loan repayments are made. Reason C is not correct. Unpaid interest does not increase the death benefit. It increases the loan balance, which reduces net death proceeds. Question 12. A policy owner allows a whole life policy with a $100,000 face amount and $15,000 cash value to lapse on its 10th anniversary and elects the non-forfeiture option that provides the full death benefit for the period supported by the cash value. Which option was selected? A. Reduced paid-up insurance. B. Extended term insurance. C. Automatic premium loan provision. D. Cash surrender value distribution. The correct answer is B. The correct answer is extended term insurance because that non-forfeiture option uses the policy's cash value to purchase level term insurance for the full face amount for as long as the cash value will fund coverage. Reason A is not correct. Reduced paid-up insurance purchases a smaller face amount of paid-up coverage rather than full face term coverage. Reason C is not correct. An automatic premium loan prevents lapse by borrowing from cash value, not by converting to term coverage. Reason D is not correct. A cash surrender value distribution would terminate coverage and pay out a lump sum instead of buying new coverage. Question 13. In a variable life insurance policy, the separate account primarily exposes the policyholder to what type of risk? A. Interest rate risk. B. Credit risk. C. Market risk. D. Mortality risk. The correct answer is C. The correct answer is market risk because separate account assets are invested in securities whose values fluctuate with market movements. Reason A is not correct. This option is incorrect because interest rate risk affects fixed income instruments rather than equity-based separate accounts. Reason B is not correct. This option is incorrect because credit risk relates to issuer default, not general market performance of the account. Reason D is not correct. This option is incorrect because mortality risk refers to death benefit costs, not investment performance. Question 14. Under which federal statute must an insurer register its separate accounts for variable life policies as investment companies? A. Securities Act of 1933. B. Investment Company Act of 1940. C. Securities Exchange Act of 1934. D. Investment Advisors Act of 1940. The correct answer is B. The correct answer is the Investment Company Act of 1940 because separate accounts meet the definition of investment companies under that act. Reason A is not correct. This option is incorrect because that act governs initial securities offering registration, not investment companies. Reason C is not correct. This option is incorrect because that act regulates trading and reporting, not separate account registration. Reason D is not correct. This option is incorrect because that act covers advisory services rather than investment company formation. Question 15. In an indexed universal life policy, what do the cap and floor refer to? A. Guaranteed death benefit limits over policy duration. B. Levels at which cash value withdrawals incur surrender charges. C. Maximum and minimum interest rates credited based on index performance. D. Minimum participation rates mandated by regulations. The correct answer is C. The correct answer is maximum and minimum interest rates because caps limit upside credits and floors guarantee a minimum interest credit. Reason A is not correct. This option is incorrect because death benefit limits are not determined by cap or floor values. Reason B is not correct. This option is incorrect because surrender charges are unrelated to cap and floor definitions. Reason D is not correct. This option is incorrect because participation rate is a separate feature from cap and floor. Question 16. How does the participation rate affect interest crediting in an indexed universal life policy? A. It limits the maximum interest credited to the account. B. It provides a guaranteed minimum credit if the index declines. C. It specifies the percentage of index gain applied to the account value. D. It determines the cost of insurance deductions from the cash value. The correct answer is C. The correct answer is that participation rate specifies the percentage of the index gain that is credited to the policy's account value. Reason A is not correct. This option is incorrect because caps, not participation rates, limit maximum interest credits. Reason B is not correct. This option is incorrect because floors, not participation rates, guarantee minimum credits. Reason D is not correct. This option is incorrect because cost of insurance charges are based on mortality and expense factors, not participation rates. Question 17. A 60-year-old client purchases a fixed deferred annuity that guarantees a minimum interest rate of 3%, credits a current declared rate of 4%, and offers a 1.5% roll-up bonus for the first contract year. Assuming no surrender charges affect interest credits, what total interest rate will be added to the accumulation value at the end of the first year? A. 4% declared rate only. B. 3% guaranteed minimum rate only. C. 5.5% declared rate plus bonus. D. 7% declared rate plus guaranteed minimum rate. The correct answer is C. The correct answer is that the declared interest rate plus the roll-up bonus is credited, since the guaranteed minimum serves only as a floor and does not combine with the declared rate when a bonus applies. Reason A is not correct. This choice ignores the roll-up bonus feature and credits only the declared rate. Reason B is not correct. The guaranteed minimum rate is a floor when the declared rate falls below it and does not apply when a bonus is added. Reason D is not correct. The guaranteed rate is not summed with the declared rate. It only provides a minimum if the declared rate is lower. Question 18. Most waiver of premium riders define an elimination period as the continuous period of total disability that must elapse before premiums are waived. Which of the following time periods is commonly used as the elimination period in a standard waiver of premium rider? A. 60 days. B. 180 days. C. 120 days. D. 90 days. The correct answer is D. The waiver of premium rider requires a 90-day elimination period of continuous total disability before premiums are waived under most standard life policies. Reason A is not correct. A 60-day period is shorter than the standard elimination period used in most waiver of premium riders. Reason B is not correct. A 180-day period is longer than the typical elimination period for waiver of premium coverage. Reason C is not correct. A 120-day period exceeds the common elimination period specified for waiving premiums. Question 19. Under a typical accidental death benefit rider attached to a life insurance policy, the additional benefit payable for accidental death is generally limited to which of the following? A. The policy's face amount. B. Twice the policy's face amount. C. 3 times the policy's face amount. D. The policy's cash value. The correct answer is A. Standard accidental death benefit riders provide an additional amount equal to the policy's face amount and do not exceed that amount under common provisions. Reason B is not correct. An additional benefit equal to twice the face amount exceeds the standard double indemnity provision of typical riders. Reason C is not correct. A triple multiple is beyond the coverage limits of a standard accidental death benefit rider. Reason D is not correct. The policy's cash value is not used to determine the accidental death benefit under rider provisions. Question 20. Which of the following life events would not typically permit exercising the guaranteed insurability option on a life insurance policy? A. Birth of a child. B. Divorce. C. Marriage. D. Attainment of a specified age. The correct answer is B. Guaranteed insurability options are triggered by events such as marriage, birth of a child, or attainment of specified ages. Divorce is not recognized as a qualifying event. Reason A is not correct. The birth of a child is a standard qualifying event for exercising the guaranteed insurability option. Reason C is not correct. Marriage is explicitly included as a trigger for exercising the guaranteed insurability option. Reason D is not correct. Attainment of specified ages is one of the primary triggers under most guaranteed insurability provisions. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.